Yeah, all right. Hey, folks. Just wanted to revert quickly to what we're doing here. Talking about a bit of crypto. And to remind you that crypto crushes degens over and over again. What do I mean by degens? I mean degenerate gamblers who take out over-leveraged positions that they can't afford to lose. And they take that risk because they believe that the risk-reward ratio is going to be something that's worthwhile. Of course, they believe that until they lose their shirts, as the old saying goes, right? Until they're liquidated, until they get wrecked. And why do they get wrecked? Well, because they take out positions that they're literally not able to lose, and that they will therefore probably lose because they're making three very simple mistakes. First of all, they don't take their profits when they're in a winning trade. They just sit in it, expecting it to get better and better until the volatility turns around on them and smacks them in the backside and takes them from what was a winning position to a losing position. Then they stay in that position thinking it's going to turn around, only it doesn't until after they get liquidated. And yes, if you think you're being smart by using 10x leverage or 20x leverage or 30x leverage, you are very much a target. In fact, if you're using 5x leverage, you're very much a target. In fact, if you're using any leverage, you're a target. If you think that centralized trading exchanges don't trade against you, you've got another thing coming. In the world of crypto, which is deregulated, unregulated rather, right? No regulations really in place. Not when it comes to trading. Yeah, sure, there's some attempts here and there, and some exchanges have certain KYC, AML stuff, but overall, there is no regulation enforced upon the exchanges not to trade against you. So whether they A book or B book exchanges, right, one type will in theory not trade against you, the other type openly will. But again, it doesn't matter, because even the type that says that they don't still sells the information to allow very big whales to trade against you and win, because they have order flow information and other information that you don't get access to, and they get it faster than you do, so they're in a better position to win the trades against you. And that is why it's critical to use leading information like the type that is used by the HFT firms, right? Think about it. Why do they use that information, right? Why is it that they use the highly relevant maths and not silly chart art? Why is it that they don't pull a Peter Schiff and draw a triangle on their gold share or chart a Bitcoin price with a silly triangle or a wedge and some random line they draw pointing up or down? It's because they know that that's garbage, right? They trade the probabilities and statistics of the volatility and the entropy and other leading information, which is derived from the mean of returns, the log returns, the standard deviation of returns, right? Variance, which is another way of saying the volatility, and standard deviation of returns is volatility. All right, the entropy, whether or not the asset is on a random walk or in a trending move, which you can tell through entropy, which you can tell through a couple of different ways, but we've got in fact, we have the best entropy indicators on the market as far as I know, by far. We can tell with the reverse mean of log returns with our indicators from Alpha Trading, which are not available anywhere else, what the future RMLR will be. We know very well, extremely accurately, what the direction of the future RMLR will be, right? And that matters, because that tells you where the potential distribution limits are and where the potential mean reversion points are. Why does that matter? Well, because what do assets do? They move away from the mean. In other words, they distribute, and then they mean revert. That's what they do. Price action is just a byproduct that just follows the returns, the overwhelming majority of the time. And if it falls out of line and out of step with the returns, it's only for a short number of candles, usually 1 or 2, 3 maybe. Very, very, very rarely will it be out of step more than 3 candles. Extremely rarely. Frankly, it's pretty damn rare that they'll be out of step more than, even 3 candles. But 1 or 2 candles, sure, it can be out of step. And that is pretty rare when it happens. It's out of step with volatility or variance, 1 or 2 candles, and then it'll follow right back in line. The reason that it goes out of step is because of things like variance, because of randomness, also known as geometric Brownian motion, right? These are things that they won't tell you in the places where degens haunt, right? They won't inform you of that because it's frankly not in their interest for you to know, right? They want you to have lagging information because that puts you squarely at a quantitatively, mathematically calculable disadvantage, right? So if you want to have a specific quantitative, qualitative, mathematically calculable edge, a literal mathematically calculable edge, then you have to use something like volatility, entropy, probability, and statistics, what we call the VEPs, right? And again, you can learn that for free. You can learn how to do it for free. You can even get free indicators to learn the basics with a free chart that you can actually use to trade. It is absolutely free to learn at alphatradinghq.com/discord. Again, that address is alphatradinghq.com/discord. And just open up a support ticket when you get into the Discord. It's free to enter. And just ask for the free volatility starter pack. And you can get on your way to learning. You got all the free educational information you need, free educational videos, free education documents, chat channels with real traders who use the VEPs day in and day out. There's access to the live streams, which are typically Monday through Friday, start at 9 a.m. We don't normally do them on holidays, but like today we did one because obviously today was a rather exceptional day on the crypto. It wasn't that exceptional, but it was exceptional enough on the crypto markets since the price action had also, obviously tumbled a very nice amount and had hit a bunch of targets that we've been talking about for a good while, down in the 7-day time frames. So, there are certainly days when we do them, even on holidays, when traditional markets are closed. But typically they're Monday through Friday. They start at 9 a.m. and they last about an hour and a half. And that lets you, get an analysis from us. And we go over, the pre-market, we go over market open, we go over shortly after market, we look at intraday targets, we look at higher time frame targets, we look at a bunch of different assets, not just crypto, but also crypto and traditional stuff like SPY, gold, Dixie, Nvidia, Tesla, Apple, whatever, all these different stocks that people typically trade, and a bunch more. So again, come learn for free. Don't be a degen, don't get wrecked just because you're using garbage information. It's time for you to learn a better way to trade, and to do that, just come to Alpha Trading. See you there. Happy trading.